Okay, folks, my comments on the market. It's been absolute pandemonium this past 6 weeks since the budget. Yeah, where to start? First and foremost, look, the chaos that the country's economy is going through at the moment is a growing pains of the money supply. Okay, first and foremost, above and beyond everything else, the pains that everyone is feeling today in their wage packets not being stretched as far, in fuel being crazy expensive, gas and electric, food, rents, all of these things, they are riding high because of massive credit expansion as a response to COVID. Providing all these loans, providing furlough pay, money is just worth less, bottom line. So you're paying more for your goods. That has led to huge inflation. So context, government borrowing was 1.8 trillion before COVID. It is now sitting around 2.3 trillion, so a 25% increase. If your pounds are not worth 25% less, if all of the goods have not increased in price by 25%, that's around about a 30,000 feet bellwether for the average. Now, different sectors are going to have different changes. Some are more exposed versus others. At the moment, it's food and energy, which is rampant. But sectors are also cyclical. But look at it just at the money supply, 30,000 feet. There's 25% more pounds available. That means pounds are worth 25% less. So following on from that, government's come out with a budget. They want to be expansionary. They want to grow the economy. They've slashed, they spoke about slashing taxes. What they didn't do is communicate with the markets how they're going to plug this gap. Now, imagine you and I have loans with the government. We'll call them bonds. We each have a bond that is £100 in IOU. The government owe us £100 at maturity. And for that £100 bond, they'll pay us £1 a year. On the news that the UK government was going to need to issue more bonds, need to borrow more money in a rising inflationary environment, investors were selling these like crazy to meet cash requirements and to have cash. The fire sale for these bonds meant that the £100 bond paying £1 was still a £100 bond paying £1, but someone was prepared to sell it for 60 quid. Now, £1 return on £60 is not the same as a £1 return on £100. So hence the tanking. The concern around the budget was that government would need to issue new debts to make up this borrowing requirement. The UK economy is funded by tax receipts and borrowing. Tax receipts were going to go down. The gap was going to be filled by borrowing. The borrowing was most likely to be at a rate higher than £1 for every £100. Hence this pandemonium, this chaos that's happened. Since then, we've got a new prime minister. We've got a new budget next week on the 17th, and things seem to be settling down. Mortgage rates have gone all over the place. It's been absolutely crazy, but this is marked increase in the business that we're seeing. I've got my spreadsheet here tracking applications in September. Again, there are multiple factors into this. I think the higher interest rates are taking a lot of steam out of the market. It means more sophisticated portfolio landlords are having their offers revisited. For the last 18 months, certainly the last 12 months, leading up to summer of 2022, there was a real challenge securing properties on market at sensible prices. Everyone and their dog was out buying property. This was because there was a glut of savings, because through 2020, 2021, there was not an outlet to spend your money. There was not a place to spend your money, save for that second hour delivery from Amazon, which was turning up at your door every single day. So people had a lot more cash, a lot more money available to invest. Where did it go to? It went to assets. So it went to stocks and shares. S&P 500 reached 4,800. And into property. So there's been this overbidding. Now people are a little bit twitchy. There's cost of living crisis coming. There's gas and electric bills. People are thinking, I'll just rein things in a little bit. We've gone from green to amber. People are stopping. People are slowing. The sellers that are still very motivated are going to have to take haircuts, and prices are going to drop. Well, this is fantastic for DGF and our clients. A lot of them are portfolio landlords. Rents across the board are up 15 to 20%, some more. Obviously, local markets are a local thing, but broad brush strokes, 15 to 20% across the country. Rents are very high. This means that the rate rises are affordable for especially the higher yielding units, the multi-lets, the HMOs, and premium products. So what we're seeing here is a 25% month-over-month growth in the inquiries we're getting and completing. So yeah, it's exciting times. Where does the market go from here? I really don't see property prices taking a huge tanking in the sub-million mark, because rents are just so high. So you guys have got a grasp of how the private rented sector drives the market, drives the UK economy. There are 25 million households in the UK. A household is a flat, be it 1-bed, 2-bed, 3-bed studio, or a house. A 4-bed detached house is a household, just the same as a 1-bed flat is a household. Of those 25 million households, 4.9 million are in the private rented sector. This is recent data, summer 21, I think, that this came out. So we're not going to be a million miles off. That's 20% of the housing stock is in the private rented sector. Private rented sector is suffering from a chronic undersupply of accommodation. Chronic undersupply of accommodation. The demand is high. It's only going up. These rents will remain extremely strong. And so the market, 20% of the market is going to be well afforded, is going to be generating a significant income, 20% over where we were 12 months ago. It doesn't feel like a shrinking sector whatsoever. The developers and traders that I think will come into difficulties, if they're not already, are those that are trading and those that are funding cookie cutter new build city centre flats. They are always the first market to be hit. They're always the most profitable market on the upswing. So that's where I would be very cautious. If you are building those out, you probably want to be looking at raising funds and a build to rent exit. If your exit is a sale, when we're funding projects, we are always telling clients, what is your exit if this doesn't sell? We've been working with 3 or 4 clients through Mark lately on flipping projects, buying projects to sell. And these clients that were looking at pretty comfortable profit margins when they were going into the deal are now having to take haircuts to the point where if they just sell and break even for the year's work, they're going to be very happy. So yeah, if you're trading property, you are taking a higher risk. If you are letting property for the long term and you have a little bit more money tied up for the next 2 years, 5 years, just revisit things after a 5-year fix. And I'm pretty confident the purchase will still have made sense. That's all from me for now. Look forward to updating you following the exciting budget next week. Thanks for tuning in. Take care.